Good morning, Ria.
Good morning, Professor. How are you?
I'm good here. Good. Here's Katie. I keep forgetting Katie's the one who can't speak to us. Good morning, Katie. And this is Cameron, am I right? Where it says Brooke? You're muted, Brooke. Okay, I forget the
There we
name.
go. It's Curtis.
What's the name again?
Curtis.
Curtis.
Yes.
Sorry about the Cameron.
Oh, that's okay.
I knew it began with a C, which is not a Curtis. It is. And Vanessa is joining us. Good morning, Vanessa.
Good morning.
All right, we got the Fab Four here. I think we're ready to go, okay? We're going to go into chapter number 13. Chapter 13. And in that chapter, we're going to learn something about inventory methods. And I hope you have a little fun with this chapter when you start doing the homework, because I kind of think these are interesting concepts to learn. Okay, chapter 13, accounting for merchandise inventory. The first thing I'd like to show you is what happens when you make an error counting the inventory at the end of the month, okay? At the end of the month, you count the inventory. And the reason you do that is what you're going to learn here is you got to take the beginning inventory from last month, the ending inventory from last month, rather, add the purchases, and that's going to give you something called the available inventory. And then from that, you're going to subtract your counted physical inventory to get the cost of goods sold. Now, what we're going to learn here is that errors in counting the inventory will mess up all three statements. Your income statement will be overstated or understated to the extent of the error. The statement of equity would naturally be wrong because you're bringing over the wrong income. And obviously the balance sheet would be wrong because you're bringing over the incorrect equity number. Okay? And keep in mind, last month's ending inventory becomes this month's beginning inventory, okay? So here's what I'd like you to start getting a little familiar with. If you understate the inventory count, your cost of goods sold is going to be overstated and your net income understated. If you fail to count something, that means that you've thrown it away as far as your calculations go, and that drips right down to the bottom line, to your net income. So you undercount the net income will be understated. If you overcount, the net income would be as well overstated. So just get the relationship between what happens to net income if you over or understate, okay? And I saw this throughout my world in cost accounting. You take a physical inventory and you try as best you can, and then in the middle of the next month, somebody finds a truck that wasn't counted. Hopefully it wasn't that much money, but we knew we were off by that amount. So let's look at it visually here. And then I think I have an Excel thing to show you with this. Here are income statements for a company, okay? And you notice it says correct, understated, overstated, okay? So the ending inventory was 20. That is what we should
Bob, we can't see your screen.
Oh, for goodness sake.
Thank you.
Jesus, boy, that makes me mad when I do that. Hold on. Talk to me. You see it now?
Yes.
Okay. Okay. This is kind of what I was just starting with here. If you over or undercount the inventory, it's going to screw up all your financial statements, okay? Counting the inventory, important, any mistakes will impact you favorably, if you will, or unfavorably. And understating the inventory, you're throwing out inventory as far as your system goes, so your net income is understated. Undercount, net income understated. Overcount, your net income is going to be overstated. And here's where I was when you thankfully interrupted me, Vanessa, to get this thing racked up here. Let's see if I can move it. Oh, darn. Okay. Here, let me just do something here. Okay, you have a column of numbers that say correct. This is year one. This is year two. They correctly counted the inventory. They counted $20,000 in the inventory. And in so doing, they came up with the correct net income number of $30,000. The next year, they're bringing over the correct inventory number. The ending for year one is always the beginning of year two, okay? So we look at this and we see that the income was $30,000 for each year, okay? But look what happens when you make a mistake. Here, they undercounted the inventory by $15,000. They didn't count that stuff on the wall over there. They undercounted. So as a result, they are going to show a difference in the net income. The difference in these two mistakes is $5,000. So take a look what the net income is for year one. It's $25,000. That's wrong. We know that's wrong. It should have been 30. The next year is going to be wrong as well because you're bringing over an incorrect beginning balance from last month. Last month's ending inventory was wrong, but you're stuck with it in terms of the world of numbers because that's your false starting point. So the next year, when you count it correctly, you notice that the net income is $35,000. 35 and 25 is 60. 30 and 30 is 60. So let's talk about that for just a brief moment here. You, as the owner of this company, you thought you expected to make $30 million. Let's think big, right? You expected to see an income of around 30 million. And because they made this counting error, you came down quite a lot to 25 million. As the manager of this company, you rely on the numbers. You might go and start laying people off. You might cancel the third shift in your factory and make some terrible decisions, which will burn you the next year. So the key lesson here is accounting error affects the current year and the next year. If you were understated one year, you'll be overstated the next year. And here's the overstated problem. Here, they didn't count 20, they counted 25, so they're showing too much income, 35 and 25. Again, if you're the manager of this company, you might start handing out bonuses. Wow, we did great. And then you find out you really didn't make that kind of profit. So hopefully find the impact of the inventory errors interesting. And it's a test. It'll be on the test. There'll be some questions on this. Two types of systems for merchandise inventory, the periodic and the perpetual. The periodic system works as follows. The month comes to an end, and you must physically count what's in your inventory, because there's no way you would know what is there. Under the periodic method, cost of goods sold is only recorded once at the end of the year. So let's take a peek at the periodic. And that's what we're going to be teaching for a while here to get you familiar with the flow of the numbers. Periodic. Merchandise inventory, account balance, most recent physical inventory, okay. Purchases account used for all merchandise purchases. Purchases are a cost. So when you bring in a new inventory item, you are debiting a cost account, and the cost of goods sold is only computed at the end of the month, okay? The perpetual system is set up so you know exactly what you have in your inventory at every single point in time, and you also know what your cost of goods sold is up until that same point in time. Under the perpetual method, we're going to debit an asset inventory, and cost of goods sold are credited for the merchandise inventory. No need for end of the year adjustments, and you may not even have to take a physical inventory. Hopefully you don't have to take an inventory. Maybe you do it every couple of years or something. If the physical inventory agrees with the amount on the merchandise inventory, well, you know you're good. Let's look at this grid here. And this is a little tricky, just a matter of getting the feel of it. Look at the different transactions between the two methods. You have a purchase on account of $100. Let's do the periodic first. As you should know now from chapter 11, you debit purchases and you credit accounts payable or cash. You paid a freight bill. You debit freight in expense and you credit cash. You sold merchandise for $80 and you paid $50 to bring that into your building. You paid $50 and then you sold it for $80. Under the periodic system, you record only the sale. You debit accounts receivable and you credit sales. Something is returned by the supplier. What do we debit? Accounts payable to reduce it, and we credit the account we learned in the prior chapter, purchase returns and allowances. Customer returned goods for 20. Let's see, we have a customer returned merchandise sold for 20. The cost of the merchandise was 15. Here, we're on the other side now. We debit sales returns and allowances because you never debit sales, and you credit accounts receivable. And now we're making the payment, and we took a 2% discount. Okay, so we settled $100 worth of accounts payable, and we get to credit cash, 98 and $2 difference for the purchase discount. So this is kind of what we've learned already, and we've gone through this. Now look at the difference between the periodic method and the perpetual method. Under the perpetual method, you don't debit a cost called purchases. You debit an asset, an inventory. You debit inventory. You debit merchandise inventory. One trick in getting this under control, where you see purchases are called merchandise inventory under the perpetual system. Purchases are used in the periodic. Purchases are not used in the perpetual. You talk about the merchandise inventory. Remember that freight expense we had here for $30? Under the perpetual system, that just is considered part of the inventory cost, which it is. You debit merchandise inventory. Now let's look at the key difference. The key difference. We sold merchandise for $80 that cost us $50. periodic method, we debit accounts receivable, we credit sales. Under this method, we do the same thing. We debit accounts receivable and we credit sales. No difference there. But under the perpetual system, we record the cost of goods sold with every single sale. So the cost of goods sold was $50. We debit cost of goods sold for $50 and credit merchandise inventory. We debit cost of goods sold, credit merchandise inventory. So you have a 4-line journal entry here, if you will. You could do it in 2 separate entries, but you got a 4-line journal entry here. You record the sale and you record the cost of goods sold. Here we have, what was this? This is, we return something to the supplier. Remember I said, wherever you see the word purchases, change it to merchandise inventory for this method. Sales returns and allowances are the same exact transaction. Customer returned something for $20. Okay, well, we got to reduce our net sales with a debit to the contra account, sales returns and allowances, and we credit accounts receivable. But we also will account for the cost of goods sold, the $15. Here, we're going to reduce our cost of goods sold because the material was returned to us, the goods were returned to us, and they're resellable. We just put it back up on the shelf and debit merchandise inventory. And again, where you see the word purchase, you just change it to merchandise inventory, okay? Most businesses, I will say, any business of any size is probably working with a perpetual system. You know, there are nice programs out there that will set up your perpetual system the way you want. Under a perpetual system, you know what's there at all times. If you call up Costco and you say, I'd like to buy 6 70-inch, high-resolution televisions for my dormitory here at City College, they will say, 1 second, sir, and they'll push a button and it'll tell them what they have on hand that exact moment. So the person, without much hesitation, says, we have 12 in stock. How many did you say you want? You say 7, and you make the deal. Under the periodic system, where you're not tracking the inventory daily, the person answering the phone most likely will have to say, please hold, sir, while I go into the warehouse and see how many are back there. Which is better customer service? Obviously, the perpetual. So most businesses of any note use a perpetual system. Compute the cost allocated to the ending inventory and the cost of goods sold using different inventory methods. To determine the cost of goods sold in ending inventory, we got to understand why we take a physical inventory. And there are different calculations used in the periodic and perpetual systems. And then another concept we're going to talk about called the role of lower of cost or market. I think that should say the rule of the lower cost or market. Taking a physical inventory, you must do it under the periodic. You may not have to do it at all under the perpetual. Compared to the accounting records to determine if the amount of merchandise actually agrees with what is reported in the accounting records. And frequently done after business hours. You know, once you ever walk around downtown at night, and maybe you come out of the movie theater at midnight and you walk past Saks Fifth Avenue and you look through the window and you see people working there and they've got papers in their hands and they're counting. Yeah, that's when a store would probably take it. Or if you can take it when there's not much out there, that makes it a little bit easier. Okay, perpetual system. And this is an old-fashioned inventory sheet. Somebody went out and counted 20 table lamps, 18 wall racks, 7 bookcases, etc. And there's the cost. And that means that there's a total, in this case, of $6,465.10 in this location. This is location storeroom A or whatever. Here, let's talk about this again. Let's talk about FOB again and something called consigned inventory. Consigned goods remain the property of the shipper, and they should not be included in the inventory of the company who actually is holding the goods. You ever go into Macy's and Macy's, when it was downtown, you would walk in off State Street and you would be cognizant, I use the word overwhelmed, by the scent of perfume. You see the ladies out there in those glass kiosks, those low shelves where they're working. That perfume does not belong to Macy's. That perfume belongs to the producer of the perfume. It could be Lanvin, it could be Estee Lauder, whoever the big perfume people are. The way a consignment works is Estee Lauder has a deal with Macy's. They say, I'll give you 100 jugs of perfume and you sell them, okay? So they go down to Macy's and Macy's says to themselves, we're gonna sell these for $100 a bottle. When Macy's makes a sale, then they pay us the $40 that we were gonna charge Macy's. Consigned inventory. Consigned inventory belongs to the people who sent the goods out, not the people who hold it. And I believe we talked about FOB shipping point, FOB destination, free on board, FOB shipping point. At that point, title changed from the seller to the buyer at the shipping point. So that means the buyer is stuck paying for the freight. The buyer, his insurance company will have to deal with any accidents or claims, or it could be FOB destination, where the seller pays for everything. It's the seller's responsibility. And I think I said, perhaps in the last class, that the FOB terms sometimes turn into a real argument. Where I worked, it was very, very important that shipments be FOB shipping point, so I could claim it in my inventory count and borrow against that asset. And other companies say, I'm not gonna let you do that. I want it to be SOB destination. I don't want to be responsible for goods I don't even have yet. Let me move this down a bit. Come on. What is part of the inventory cost? We have inventory cost. Proper cost must be assigned to the inventory after we count. Cost means all necessary and reasonable costs incurred to get the goods into your business. And these components consist of the purchase price, okay? We bought 1,000 barrels of oil from a refinery in New Jersey. And then it cost us $5,000 to bring that oil all the way across the country to our facility. Those delivery costs, that freight, is part of the inventory cost. We had to insure it on the way across the country. That would be part of your inventory cost. And maybe we had to put it temporarily into storage until the quality was verified. That could be part of your inventory cost. There could be a whole bunch of them. Computing the cost of inventory. Identical items are purchased at different times and at different costs per unit. Who knew? Identical items are purchased at different times and very frequently at different costs per unit. You bought something on January 1st for $100. You bought it again in February. Now the price is $120. You bought it again The next month, it went up to 150, okay? In our class here, we are assuming that prices are always rising. No economy can sustain itself if prices are constantly going down. You want to have some inflation, okay? Not like we have now. Now we're getting into some troublesome area in the economy. Any of you who put gas in your car know that. So, of the goods available for sale, how do we decide which units were sold and which units remain on the shelf? We've got 4 inventory methods we're going to talk about. And methods can be applied under the periodic or perpetual systems. This is an example similar to depreciation expense, where the company can choose how they're going to expense their inventory. So let's take a peek. There's a method called the specific identification, and this one is super easy in that the inventory items must be, physically different, have serial numbers, cost, you've got the cost on the invoice. Usually practical only for businesses in which sales volumes is relatively low and the unit value is high. Specific identification means that the units you sold can be identified to the ones you bought in May, the ones you bought in June, the ones you might have bought back in January. It matches the physical flow of the inventory. When I bought my car at Perry Lincoln about 10 years ago, I went in there and I said, okay, let's do it. And I handed the guy my check for, whatever the car cost. He did not say to me then, okay, Bob, you can go out into the parking lot and pick any Ford Edge you want there, the keys in the ignition, and go. No, it's not like selling soda or something simple like this. Big ticket items need to be tracked in case there's a problem with that car. So they specifically know what car I bought and when they bought it. And this should look a little more clear as we go through these methods here. Okay, say hello to a very important template. You're going to see a lot of this in your homework, okay? We start our inventory with 40 units, okay? And we paid 62, and you notice the price went up each time. But let's just check the units. We had 40 units at the beginning of the month, and then we brought in another 60, another 80, and another 70. So our total units available becomes 250. It's 40 plus 60 is 100, plus 80 is 180, plus 70, 250. Now the month is ended. We have to figure out, of this total of 250, which represents the most we could have sold, you can't sell more than what was available. We need to know how much of that cost remains in the inventory and how much it's cost of goods sold, okay? So we take that available number and we subtract the ending inventory. So that's your template. Beginning inventory plus purchases equal available, and then you subtract your physical count, and the difference becomes the cost of goods sold, okay? Specific ID. Okay, we had sales. We looks like we sold 200 printers. Under specific ID, they're telling you that 30 came from the beginning inventory, 30 came from this beginning inventory, 50, 60, and 60 came from the next 3 purchases. We sold 50 from here, 50 from here, and whatever that was. Total cost of goods sold, 200 printers. Specific ID method's pretty easy. There'll probably be a multiple choice question on that, or maybe a little calculation. on the next test. If we were in the classroom, you would get bombarded by me with a few of these grids to do on paper, okay? And specific ID. Let's take a look. Take one more look. Beginning inventory was 30, and then we had the extra purchases, and we came down to here. And what they're saying is we had 30, and we sold 20 out of that. So we sold 10 out of that. So that becomes the cost of goods sold. Let me start up again on this. I hate this presentation. Cost of goods sold. Remember, they said they sold 30. 30 times 62, 1860. That means we have 10 remaining in the inventory. Let's get away from specific ID. Okay, here is a method that is used by, I don't know if I want to say majority of companies, but certainly a plurality. Many companies use what's called the FIFO method. FIFO, first in, first out. We're assuming that the first goods purchased were the first ones sold. Therefore, the latest goods purchased remain in the inventory. Whenever possible, a business is probably going to try to sell the old goods first before they, become obsolete or spoil. FIFO often follows the movement of the goods, but that's not necessarily true. So let's take a look at FIFO. Under FIFO, we had a beginning inventory. Cost of goods. Again, I don't like this presentation. I should have looked for the other one. We sold. Let's see something. We sold 200 items. Okay, let's get our bearings here. All right, here we go. Maybe I can edit that little part out, huh? Okay, we know we sold 200 items. Under FIFO, we sold 40 from here. We sold 60 from here. And we sold 80 from here. And the remaining 20 from there. That leaves us with $50, not $50, but 50 units in the inventory, costed out at 68. In other words, we're pretending, and I'm using that word deliberately, we're pretending that we sold the 40 items first. We may or we may have not done that. This is not meant to be the physical flow. This is a costing method companies can choose. Beginning inventory was 40. Okay, so that means the cost of goods sold was 62 each, 60 times 65, etc. So we come up with the cost of goods sold of 13,100, and we got 3,400 still sitting in the inventory. Weighted average method. This is super easy. Computes an average cost of units. All you have to do with this one is go to your available line. The available line. You see your available line here, ladies and gentlemen? You have a total cost of 16,500. We have 250 units that we have to account for. Just divide out the 16,500 by the 250, you get $66 a unit. All you have to do then is multiply the number of units sold times 66 and the number of units remaining in inventory by 66. It's a very easy method. Don't make the mistake of coming up with the average price by adding vertically here. That's not going to give you the right number, okay? You do it horizontally. Cost of goods sold, 200 times 66, 50 times 66. One of the advantages of weighted average is the simplicity. Yes, it is a very simple method. Let's talk about another method that's going to make you think a little bit, called LIFO. LIFO, last in, first out. Here, we pretend that we sell the newest stuff first. Assumes that the sales in the period were made from the most recently purchased goods, and the earliest goods will remain in the inventory until we go that far back. And there's some justifications for this. The physical movement is actually last out in some cases. Current costs give you a better measurement of your income. But the real reason companies choose these different methods is for tax purposes. Your net income is going to be different under all four methods. So we'll take a look here. Cost of goods sold, huh? Okay, we sold 200. Under this method, we sold the 70 in the third purchase. We sold the 80 here, and we sold the entire 50 here. That means that we still have 50 left in our inventory, 40 from the beginning inventory, and 10 left over from the 60 of the first purchase. Only the specific ID method reflects the actual flow of the goods. You know, we're looking at LIFO here. You see that 40 units here left in the inventory? The Mesa fruit stand uses LIFO for their accounting. Did you know that? What that means in theory is that they never sold the first bunch of bananas they put up there during World War II. Now we know it's ridiculous. We know we sold that old goods, but you're allowed to pretend that you didn't for tax purposes. Okay. I can think of a business or two that actually uses, might use a little bit of last in, first out. A hardware store. You know, your uncle opened up a hardware store back in 1960. And he filled a barrel, a big metal 55 drum. He filled it with nails, poured a little oil in it, and you have all these nails there. And customers come in and they scoop up the nails that are naturally on the top of the barrel. So you can think of it that way. You're always selling the newest additions because when you replenish it, you just pour the new nails on top. So that might be an example of where LIFO matches the physical movement. But really only the specific ID method matches the physical movements. The other cost flows, FIFO, LIFO, weighted average, have nothing to do with the actual physical movement. Any one of these methods could be used under any set of physical flow conditions, okay? Let's see the impact of the method you chose, okay? Goods available for sale is the same for all methods. Let me talk about that for a moment. Your goods available for sale is calculated by taking the beginning inventory and adding the purchases after that. You add the beginning inventory to the purchases subsequent, that gives you the available line. That's going to be the same for each method. All we're saying now is that that number, that available number, is now going to be broken out between the inventory cost and the cost of goods sold. When prices are rising, as with the printers, FIFO gives you a high gross profit. Let me repeat that. In an economy of rising prices, FIFO results in the largest gross profit or net income, okay? The questions on the test will always be in terms of a rising economy. I don't think you're going to get anything about deflation. When selecting the inventory method to use, there's some rules involved. The IRS requires the use of the same inventory for tax and financial purposes. Physical flow means nothing. And you just can't change methods month to month. If you want to change methods, you have to do it probably at the end of a fiscal year, and you might have to restate the prior numbers just to show how it would have looked with the new method. Okay, here's an important grid here, okay? Let's concentrate on this. Sales, 18,000, that's the same. Your beginning inventory, that's the same. And the purchases are the same. So the goods available for sale at the end of the month was $16,500. Under specific ID, the inventory count came to 3,290. So our cost of goods sold is 13,200. Gross profit 47.90. Look what happened with FIFO. Our cost of goods sold is not 13,210, it's 13,100. We ended up with a higher net income. You will always have a higher net income in FIFO as long as prices are rising. LIFO, skip over LIFO. Wow, look at this. Our income, or gross profit, if you will, was only $4,630. That's a pretty big difference between the 49. And the weighted average, as you would expect, would be somewhere in between them. LIFO will give you a low net income, all right? Why would companies choose one of these methods over the other? Well, LIFO, you're going to have lower reported net income. You're going to pay less in taxes. FIFO, it was $4.9 million. This is $4.6 million. The difference here is $270 million. We're a big company. Difference is $270 million multiplied by a 30% tax cut, your tax rate. This company here saved $81 million in taxes over FIFO. So you may use the LIFO method to consistently lower the net income and thus pay fewer taxes. Companies, though, don't always use LIFO. They go for FIFO because they want to make a big splash. They want to show as much income as they can. They want to announce their earnings and see a story in the business sections that says, Kimberly Clark announces record earnings. They're willing to pay that tax to be able to do that. Now, everything we just saw was the perpetual, was the periodic system. Perpetual, continuous record is maintained for everything. The balance of the merchandise inventory account shows what should be out there. And the merchandise inventory is the control account. When we say control account, we're talking about an account from the general ledger. Accounts receivable is a control account, and the subsidiary was the schedule, if you will, of accounts receivable. Here, we have merchandise inventory, and with the perpetual system, we have a report that says this $1 million in inventory consists of these 500 items, okay? I'm going to skip that. Okay, here's something to chat a little bit, huh? Conservatism principle. That is a generally accepted accounting principles. Remember that from chapter 1, GAAP, GAAP? Conservatism basically says you must always report and anticipate a loss. You can never anticipate a gain, okay? So when in doubt, a lower asset value and net income measure should be used. If the asset increases in value, no formal entry of the gain is made. Your company bought a couple of acres of land adjacent to the beach here, and they had a store or something there. Well, they paid $100,000 for that land 50 years ago, and now it's worth $10 million. It's still going to be $100,000 on your financial statements. You cannot record a gain until you sell the asset. But if it decreases in value, you got to recognize the loss. My company, we bought some land, and then the land turned out to be toxic, and our land turned out to be worthless, huh? That loss, we have to recognize immediately. Conservatism says we never anticipate gains. We always anticipate and record the losses. Now, along that line comes another accounting principle. It's called the lower of cost or market. If the value of inventory declines while it's being held, we have to recognize that loss. And the purpose of lower of cost or market is to recognize such losses immediately and lower the inventory to a proper value at the same time. Lower of cost or market. Cost means what you're paying for, what you paid for the goods. Okay, you sell T-shirts, and you went out and you bought a bunch of T-shirts for $5 a piece, and you were selling them for $20. The cost would be the $5. The market means what the goods are worth right now. Okay, cost means what you paid for it. The market means the current cost to replace the inventory. In other words, what is this garment selling for today? Okay. The method assumes that a decline in the purchase price is accompanied by a decline in the selling price, and thus signals a decline in the value of the inventory. Yeah, you're probably going to have to reduce your prices if the market has gone down. For example, you bought a bunch of T-shirts, and you were selling them like crazy. You bought them for $10, and you were selling them for $30. And then your salespeople start coming to you, and they're saying, "Jesus, no one's buying these T-shirts anymore. No one. They're totally out of style. We'll be lucky to get $5 for them." You have to replace that inventory that you bought for 10 down to 5. And here's a simple example of this. Remember, when you're doing these lower cost or markets, you're concerned with the lower number. The lower number is the one we're going to be interested in handling. So here, we bought something for $8,000, but the most we can get for it now is $7,000. We bought $8,000 worth of fax machines. Nobody buys them anymore. So they're only worth $7,000 now. That is the amount that we're going to put in the inventory. Here, we purchased something for $9,000, and the market price is $10,000, so we're okay. So we bring the $9,000 over to the inventory calculation. Here, $7,000, $6,500. That's a loss of $500. So we bring the $65 over here. So our total inventory value is $22,500. When it was $24,000 before, we suffered a loss, it looks to me, of $1,500. Two ways to calculate the lower cost. What they're saying here is you don't necessarily have to do every single item, but if you have similar inventory items, for example, you have T-shirts and nobody's buying these T-shirts, you can just come up with the lower cost value in aggregate for the whole total. You don't have to go through every single shirt. The journal entry needed to reduce the merchandise inventory. Well, $23,500 is what it is at market, huh? So we have a $500 difference. $500 difference. We debit an account called cost of goods sold dash, in this case, they're calling it a loss on write-down of inventory. Where I worked for many years, call it cost of goods sold, lower of cost of market, something like that. And you credit the inventory. You don't have that inventory anymore. You recognize that loss. We're getting into the estimated methods. No, we're not. No, we're not. Retail method. Yeah, we've covered this already. This would be redundant in terms of details. So that pretty much concludes today's speech. Anybody have any questions?
I have one question about the homework. I don't know if this is the right time to ask or not.
Yeah. No, absolutely.
Okay, so it said,
can you share the screen with us, Vanessa? Is it something you can share?
Oh, I don't have it up right now. I don't know.
Okay, well, go ahead. Ask your question.
I'm not very tech savvy, but the weighted average lower of cost or market. So it had like a list of prices for things, and then the price went down from 30 to 26.
Yep.
So then how do I figured it out, but I'm not exactly sure how I.
Okay. Well, it sounds like you bought something for 30. You bought something for $30, and now you're finding out that it's only worth 26, huh?
Yeah, but there was a whole list of things. So then it was a weighted average of all of those. So did we put that 26?
I wouldn't call it a weighted average, I don't believe. You might have had a list of 20 items or whatever, and some of them, the prices were okay, and some of them, they went down.
Yeah.
So you bring over to your column on the right, the lower number.
Okay. And then from there, because they want the weighted average. So from that, then I do the weighted average.
Yeah.
Okay.
If the weighted average is, you get that from the available line.
Okay.
Just divide it out. Yeah, that's a good question.
Okay.
All right. What do you think, Vanessa? Anybody else have a question? Any comments? It's all good. Should we adjourn the meeting, Katie? You can't hear Katie. Yeah, we'll pack it in for today, guys, okay? Hope to see you on Wednesday. Thank you.
Thank you.
Bye-bye.